Hi, good afternoon, everyone. So, OurCrowd asked me to come up here and talk about asset allocation and how it relates to venture capital. And I'm just struck because, I'm hearing about all these companies. They're, curing cancer, taking cripples and teaching them to walk, the blind to see. It's a over 2,000-year tradition in Jerusalem, and so it's very appropriate here. But then you go to asset allocation, which might be the most boring topic, so I felt like, okay, well, this is a little bit of a challenge. As Shmuel mentioned, I'm at Stifel, and we are a wealth management business. We're based in the United States of America, in St. Louis. We run about $350 billion of assets for our clients, so our clients entrust us to invest their assets. When I think about venture investing, it's a very, very small piece of what we do when we handle wealth management. In fact, really in a lot of ways where we touch with venture investing, it's either through investing in funds traditionally with clients for a small portion of their assets, or it's really the source of wealth. And so we have a lot of clients who are actually made their money because they were entrepreneurs and created a company, or they ran a family business for years and then were able to sell it to another firm. And our job as a wealth manager is really to preserve the wealth. And that's where asset allocation comes in. So it's not about looking for a 4x or a 10x return. It's about preserving someone's wealth and thinking about their goals over the long term. So when you think about asset allocation, in a lot of ways, it comes down to math, right? And you'll see if you look across J.P. Morgan, Goldman, Stifel, Merrill Lynch, all of these different firms, their asset allocation recommendations tend to look fairly similar across the broadest asset classes. Now at Stifel, we look at 13 major asset classes, and we leverage all of the work that's been out there from Markowitz when he started first talking about modern portfolio theory, Fisher Black, and Robert Litterman came up with the Black Litterman model in the early 90s, and that sort of took a little bit of a different take. And it's almost a way of thinking about the world and the investable asset classes that are out there, and thinking about the proportionality of those across the universe, and then thinking, how do you optimize that? And how do these different asset classes, so 13 major asset classes, we have 7 additional sort of minor strategic asset classes, how do they correlate to each other? And then how do you develop a portfolio that's going to protect someone and make sure they're growing with the market, they're keeping up with inflation, and their portfolio continues to develop? And the way we do that is we have forward-looking assumptions. We're really targeting volatility ranges based on someone's risk tolerance. And so most firms break it up into 5 or 6 risk categories. But ultimately what they're really looking at is, what is the volatility that portfolio can withstand over a long period of time? They're never going to be right in a particular year, but over a long period of time, how should that play out? And what types of return objectives do they have? And we've incorporated things like capital market assumptions across each of those asset classes. And that's an important concept because if you go back 10 years ago, the capital market assumption for cash, just holding US dollars, let's say as an example, capital market assumption was that you expected, say, maybe a 5% return on cash. And nobody, people would laugh at you now. And if you're thinking about a 20-year view, people are much closer to zero today. That we have central banks with negative interest rates on their currencies today. So, 15 years ago, that was unheard of. And it really changes, if you're thinking about a long-term goal, how you allocate those assets. Our views are 20-year views. When we think about strategic asset allocation, it's over a 20-year period, and then we tactically weight different asset classes at any given time based on relative value. So again, all of that's math, all of that's relatively boring. There's an interesting part of wealth management as well. In addition to working with entrepreneurs who've been very successful and really helping people with their personal lives, it's about getting to know people, okay? And that's a major part of how we think about asset allocation to some degree, but really deploying capital for the most part. And what we learn about people is we learn about, obviously I talked about risk tolerance, but we learn about people's personal biases. And so we have financial, behavioral finance tools that we use to understand where people have a bias. Interestingly, entrepreneurs tend to have a very high tolerance for risk. That's not surprising, but it's interesting. A lot of other investors have low composure and are very risk averse. And so what we do is we test our clients to see where they fall on that spectrum. If someone's highly risk averse and they invest in single stocks, every time the stock goes up, they feel like they're missing out, they buy. When the stock drops, they sell. When it recovers, they start to feel good again, they buy again. And if you repeat that cycle for a while, you'll have no money left, right? So better to know that your bias is towards that. And then you can use tools to smooth that, whether it's derivatives or whether it's just ETFs and diversified exposure. Venture capitalists who make a lot of money, oftentimes they're looking for their serial entrepreneurs. They're looking for the next investment. So that completely turns on its head how you think of the asset allocation for that client, because you're thinking of their very specific personal objectives. And then the other thing I would highlight that we see very often around the globe, especially in my time at Barclays, is something called home country bias. And home country bias, maybe in Israel and in Jerusalem, might be entrepreneurial, right, in nature, and you need to think about that. But I remember working with people in Portugal, and their equity portfolios, so think of a 60% equity, 40% bond portfolio. The 60% equities was 100% Portuguese equities. What could go wrong, right? And so we think about this home country bias and making sure that we're thinking about the world. We think about, in the U.S. equities, then we think of international equities, we think of emerging market equities, and make sure we get the correlations and the distributions between those right. When we really drill into private equity, and so really the topic of VC, we recommend anywhere from a 2% to a 12% allocation in a portfolio to private equity. That will cover, and it's really private assets. We'll have a slice of private equity in there, private debt, and other private assets like private real estate. The private equity piece, a slice of that is venture. And typically we expose people to that through funds. That's what most of the big firms do. Stifel has a very innovative approach that we've launched with OurCrowd very recently. So if you go around the globe, and certainly in the US market, typically, before we will go to an individual investor with a single line investment like Beyond Meat before it's public, we require a client to have $500 million in assets. An individual investor is worth $500 million. Some firms go as low as $100 million. So you were talking about the uber, ultra, high net worth clients that get exposure to this asset class. If you were in the plenary session this morning, you will have heard the chairman of the Securities and Exchange Commission in the US actually had a quote. He said, companies are staying private longer, and we need to figure out how to get individual investors exposed to that asset class, that venture asset class. But firms in the US are afraid to do it, and firms globally are afraid to do it because it's risky. The path to an IPO, to a monetization, can be long. Liquidity needs can come up, and so we really worry about these things. One thing we're doing at Stifel is we're saying we need to turn that on its head. We actually have to take that view and say, how do we get this important asset class in people's hands? And so we've actually lowered the bar as low as you possibly can go in the US, which is $1 million net worth. And we're making single stock investments available to people with as little as $1 million. But from an asset allocation perspective, we are essentially managing the level and percentage of exposure. So our recommendation to a client is they have no more than 5% of their overall portfolio. When we measure that as their assets at Stifel, we want to be able to see it. A lot of clients come in and say, I'm worth 50 million. You find out later they're worth 5. So we have to KYC, know your client. We have to do all of that work. And so here what we're doing is saying, if you have $1 million at Stifel, we will let you invest $50,000. And we will limit it to 1% of your assets in any individual deal. So now you can take these exciting opportunities, exciting deals, and say, okay, take $10,000 of your $1 million portfolio, put it in 5 different deals, right? Now you've got some chips on the table. We look at venture as really correlating very highly. It's a 97% correlation to small cap stocks. That's really how it plays out in the long haul. So we think about that when you model it, as it really factors in with your equity allocation. but we put in that private asset bucket, we limit it, and we want to give people exposure to this exciting asset class. There's great things about it. In addition to what the other speaker said, it's the liquidity premium that you get. It's this great opportunity that's out there. And frankly, a lot of that is washed out by the time you get to the public market. So the opportunity has already passed before you get there. And we're really committed to making sure that we have individual clients who can get access at a reasonable price, at a reasonable exposure level to this asset class. That's how we think about asset allocation in venture investing. So, thank you.